by now. Audra's here as well. I'm from Brothers. Of course, she's from CSU, Employee Housing Programs Coordinator. And we're going to spend a few minutes here taking a deep dive into conventional first-time homebuyer options. First and foremost, if anyone has any questions or wants some more information on what we're speaking about, please utilize the chat and Audra will try to field that for me. We're going to try to be really on time today. Sorry about the little gloop there with the being able to see it. So if we can't get to questions until at the very end, or we don't get to your questions, feel free to leave them in the chat. If you also leave your email, we can answer you directly. Here we go. So we're going to cover these four topics. Conventional loans described. Many of us hear the term conventional loan. Some of us don't quite understand what a conventional loan is and isn't, and so we'll go through that. Topic 2 is the pros and cons of conventional lending, why you might choose it as a first-time home buyer product, especially since they're not always offered and they are great first-time home buyer products. Topic 3 is some specifics on Fannie Mae and Freddie Mac and what they offer as first-time home buyer options, and with a limited amount of 3% down. And then topic 4 is just a real brief bullet on how you might layer a conventional loan with down payment assistance. And we will dive into that very deeply on Thursday. If you haven't signed up for that class and you're interested, feel free to register either at noon or 6 p.m. And we will go through layering aspects with the down payment assistance and some special programs that are available to think about layering with the first-time home buyer conventional loan. Makes it especially great for a first-time home buyer. So to describe a conventional loan, they're either with an organization called Fannie Mae or FNNA, and they're Federal National Mortgage Association, typically known as Fannie Mae in the industry. They were designed in 1938 by Congress out of the Depression era and the loss of so many people's homes in 1929 and afterward. So as part of the New Deal, they came a way to develop a good fixed rate loan program that was helped by the federal government. Freddie Mac came out a lot later. The true name for Freddie Mac, or FHLMC, is Federal Home Loan Mortgage Corporation, and it came out in 1970 as a part of the Emergency Home Finance Act to expand the secondary market. Now, secondary market is a confusing term if you have a limited idea of what a conventional mortgage is. It's certainly not a second mortgage, okay? Secondary market is where they go to sell off the Fannie Mae Freddie Mac loans. So if you think about it, your lending institutions, your banks, your credit unions, your brokerages, they can't loan 30-year loans. 30 years is a really long time to tie up the size of a mortgage loan. So let's just use even $300,000. Let's say that a bank has $1 million to lend at the moment in time on their books. Well, in Colorado, that could be 2, could be 3 loans, perhaps 3 condos, 2 homes in the Larimer area. So that's, bam, then they don't have any more money to loan for the next 30 years. So of course that's not going to work. So that's what the conventional mortgage is there to do. It gives these organizations somewhere to sell off your loan. So conventional mortgage loans originated at banks, credit unions, mortgage brokers, uh, based on the guidelines that are generated by Fannie Mae and Freddie Mac. So the guidelines are established. They're pretty much paired the same. There's a couple of caveats that they're always doing a little bit different, but basically they adhere to the same style of guidelines. So a Fannie Mae could be a Freddie Mac with much ease. These institutions, that would be the lender that you go to and originate your mortgage, they're going to sell them to Fannie Mae or Freddie Mac. So they want to follow those guidelines. So Fannie Mae or Freddie Mac will buy that mortgage. When they buy that mortgage, they buy the note, they pay back that lending institution. So therefore that money becomes a revolving source that lender can go and make 30, 40, 50 loans in a year or more and not have their own money tied up. Now, they may sell the servicing. If they sell the servicing, you'll get a goodbye letter from the original mortgage company or origination of that mortgage. You'll get a goodbye, and you'll get a hello letter from the new person that you're going to make your payments to. The servicer is the middleman, so to speak, that makes sure that your taxes and your homeowner's insurance and your mortgage insurance, if you have it, are all paid timely. The servicer is who you're going to call if you want to change your homeowner's insurance or you want to find out what your tax amount is without calling the assessor. So the servicing can be sold or can be retained, and they could still sell the note to Fannie Mae or Freddie Mac. And as we spoke about already, this allows those institutions to reuse those funds to originate more and more loans, thereby making that asset actually work even harder. Now we're going to talk a little bit about the pros and the cons of conventional lending. What I like to bring up is often when people are looking for their first home loan, they will go to their reputable lender and they'll say, hey, I'm a first-time home buyer. What would you suggest? Well, lots of times people are convinced to go to a to an FHA loan. There's nothing wrong with an FHA loan, but they can cost a lot more to originate. So one of the pros of a conventional mortgage is the fact that the mortgage insurance, there's not the upfront cost of an FHA mortgage insurance. And then FHA also has a monthly amount. So you pay an upfront fee. Lots of times the lender will say, oh, don't worry about that upfront fee. We'll just roll it into your loan amount, which is acceptable to FHA. But if you have a decent credit score and, 660, 680 or higher, and you have 3%, not 3.5%, because FHA requires 3.5%. If you have 3%, decent credit, ask first to be run through as a conventional loan and see if this comes up as an approval for you. And I say run because everyone uses what's called the desktop underwriter or the loan prospector, which is the automated system of either of those conventional lenders. They actually use those machines as well for FHA, but ask for a conventional loan. It's 3% down. There's no upfront mortgage insurance. And then as you can see in the pros, the second one is once that loan amount, the LTV, loan to value, comes to 80% or less, the mortgage insurance can be dropped automatically by the servicer. So, very much worth it because if you originate an FHA loan, most likely that mortgage insurance is going to go ahead and go with the entire time of the loan. So you won't have that benefit unless you refinance the loan later. And refinancing always costs new origination points and an appraisal. So in terms of um, looking to protect yourself from having to do some kind of a refinance in the future, you certainly want to think about doing the conventional loan up front. Guidelines are pretty much universal. You need decent credit, but not, if someone says, oh, well, first time home buyers, we strongly suggest they get an FHA loan, then just say, well, I want to see whether I can be approved for conventional. It is within your rights to ask for that, and it's basically a flip of a switch for that mortgage originator. In the case of a default, say, 2 years from now, someone loses a job, the options are pretty much the same between an FHA loan and a conventional. There's some misinformation out there that a conventional lender won't work with someone in trouble, and that's so not true. Of course, the sooner you reach out, the better it is, but there's protective mechanisms and things built into that long note that you have to sign at the loan closing that gives you some rights to work some details out with them. So the other advantage to a conventional loan is oftentimes the rate is a little bit better, can be as much as 0.5%. And you might think, oh, what's 0.5%? But when you amortize a loan over 30 years, 0.5% can be quite a significant difference in the amount of finance charges you will pay. And the other great thing is that it requires 3% down, not 3.5%. So some of the cons of a conventional loan, mostly it would have to do with your credit. Say you have a 660 and you have an open collection item that's just a sort of a small hiccup on your credit report. Things like that, FHA might take over a conventional. But basically a conventional is the cheaper choice in the long run, will cost you less over time. But FHA is still a good choice. So, if for some reason somebody comes back and says, well, I've been unable to get an approval through the automated system on a conventional loan, would you consider an FHA loan? Don't say no if it's the first opportunity for owning a home, if you have the 3.5 saved versus the 3. One other con to would be that the credit scores, or the credit standards, I should say, even more so than the score, is a little bit different, a little bit higher than an FHA loan. But things to keep in mind, home owning takes some planning. So if your score is close, you might really consider waiting, getting that score bumped up just a tad, because both conventional and FHA use your credit score to assess what you will pay for your mortgage insurance. So the higher the score, the cheaper the mortgage insurance coverage will be. Now, I threw this chart on here just because I like to show people that you can see Fannie Mae, Freddie Mac is 73% of all of the loans that are on the books. Now, this is going to be for first-time home buyers, but this is going to be all home buyers, okay, as well. So what I like to show is, see how FHA only takes up 13%? And then when you look at this 13%, there's like 38% of the 13% that are first-time home buyers. So first-time home buyers are more specifically, over here, sorry, are kind of slotted in to FHA. So that's why I say ask about the conventional. It's within your rights, and it's a flip of a switch. They can let you know whether you can get away with a 3% instead of the 3.5, and if you can save money at the loan closing and over time. The green is the VA loans. There's 9%, and this is the US, by the way. And then the USDA loans, this would be for rural America. And there are some places in Larimer and Weld, and a couple other counties that are associated very close to you, that the USDA loans would be also an option. Topic 3. So here are the specifics on the actual loan options that may be available. Okay, so just to be confusing, they both, Fannie Mae, Freddie Mac, have 2-3% down scenarios. So the standard Fannie Mae 3% down would be for first-time home buyers, but it would can also be on a certain parameters and approval for someone who has been a homeowner or is a homeowner. So they do require homeowners, first-time home buyer classes for those who are first-time home buyers. This one has no income limit. So keep that in mind. If you're a high income person but haven't been able to save due to circumstances, still look at this first option because you can be above the 80%, what they call the area median income. We'll talk about that more. The chart can also be available. You can find it online. It's a little hard to find the most recent and the most accurate. So feel free to put that in the chat that you'd like that sent to you, or our emails will appear after the program. And you can certainly, if you feel like you would like it more private, please send an email and say, could you attach those charts to me? And we'll just get those over for you so you can assess your own income. If you're over 80%, this 3% down can be an excellent program. As you can see, it's for one unit, principal residence. So that would be a single family detached home, as they're called in the industry, a condo, a co-op, and then a PUD is called a planned unit development. And sometimes those are hard to tell the difference between a planned unit development. Could be a quasi townhome, could be actually a condo with a small amount of land that you're still responsible for. And then the mobile home, or excuse me, manufactured advantage, which is a particular type of manufactured housing. So it has to meet a certain standards that can go to 97. Otherwise, the max they'll do on manufactured is 95%. So then, a great fixed rate, and then standard mortgage insurance. And, you keep hearing me say mortgage insurance. Well, mortgage insurance is there to protect the lender if you're not aware of that. So you have your taxes and insurance, your homeowner's insurance, and then you have mortgage insurance if you're above 80% loan to value. So as it climbs up to 97, you will pay the most premium for your mortgage insurance. But if your score is even high, the highest you could, so like you have a 780 to an 800, then your mortgage insurance is going to be the cheapest at the 97% versus you have say a real good score at a 680. That's going to drop it down to the next tier. And so, we could spend a whole hour on mortgage insurance, but the higher your credit score, the cheaper your mortgage premium will be. The Home Ready, the 97%, that's going to be for people who are at 80% area median income, AMI, sometimes called. And as I said, we can certainly get that chart over to you. That one comes with a reduced premium. So you're gonna have a little less to pay for your mortgage insurance. And you are going to be required to take the first-time homebuyer classes. But, good organizations there, both end-to-end, neighbor to neighbor, and brothers, good places to get the CHAFA Homebuyer Education Class Certificate for free. And it is also at the 3% down. Now, if you're approved, let's say you're so close to that 80% area median income, and so you're a little afraid you might be over or under. And so you can say to your originator, please run me with the Home Ready so I can see if I can qualify for the lesser mortgage insurance and the 3% down. And then if for some reason, that automated system thinks you're over, it's going to, in fact, offer you the standard, but you would ask the underwriter, or excuse me, the originator, to go ahead and send it through the desktop underwriter with the standard. And, it's literally a flip of a switch. They can do that and let you know. The same is true of Freddie Mac. Freddie Mac has two different names for the same types of programs. Home One is going to be for the one where your income does not matter. So, you again, a high earner, and you go to someone who sells to Freddie Mac, then you would want the Home One option with the 3% down. Pretty much everything's going to be very similar or the same as the Fannie Mae standard. So your mortgage is going to be, your mortgage insurance is going to be at the standard rates. The Home Possible, again, is going to be for those people who are applying for Freddie Mac that are at or under 80% of the area median income. The mortgage insurance is going to be a little less. And then home buyer education is going to be absolutely required for the Home Possible, and it can be based on what the automated system says. Now, I know we are all in the world of AI, and so everyone's thinking automated system means AI, but in this case, Fannie Mae and Freddie Mac have been using this automated system, of course, with revamps and changes, but they began to use the same computerized decision maker in 2002. So it's been there for a long time, and it does make really good decisions. And it's very interesting how it makes those decisions. But again, ask if you're being told, oh, I think FHA is the way to go. Ask your originator to at least try for a conventional loan and see how that comes back. And then just a few minutes on the layering aspects. This again is the best way to describe how you can take a standard conventional loan and you can layer it with down payment assistance. So as long as you have your own very own saved 3% of your own money, then ways to manipulate the system and bring that loan balance down even further, then here's a couple of suggestions. Metro down payment assistance. Now you might think, well, I'm not going to qualify for that because it's not in the counties I want. It's called Metro DPA. You can see you do go to the denvergov.org website. I would not look up just Denver Metro DPA because it kind of steers you towards specific lenders that are out there trying to, kind of grab the business. Go here to this website. Be glad to send these to you. And this whole presentation will be available on your employee website, by the way, so you can access the same information slowly. But $25,000 or less based on the income level could be available, and it's definitely available in Larimer and Weld County as well. And it goes up to the max income of $188,250, which is above the 80% area median income. First Bank has some very nice programs with some down payment assistance available. Theirs are held to the 80% area median income, and they can be as much as 20% of the purchase price or $30,000, whichever's less. And you can see they're pairing off with Impact Development Funding.org. This website also has this information, as you can see. Same website for this one. Down below is Colorado DPA. This particular down payment assistance program, oh goodness, is also this one here, Colorado DPA, is also going to be found with many of the same lenders that do the Metro DPA. So if you need any help with finding lenders that are not afraid to use both the first-time homebuyer 3% down and down payment assistance, we will be able to also post you at least 3 reputable lenders in your area, including a First Bank right down the street or in Fort Collins there, where you would find very good resources for their programs, and then a couple other people that do all the other 3 that are there, including the last one here, which is Colorado Housing Finance Authority, also known as CHAFA, which if you've done any delving into first-time home buyer, you've seen that program come up. So the CHAFA loans, lenders that are going to do the Metro DPA and the Colorado DPA also can combine that with a CHAFA loan, and CHAFA does conventional loans on top of that. So, it does get pretty complicated, and we will spend a lot more time on Thursday if you're interested in the down payment assistance and how you might pair that with a good conventional loan. That's going to come up in greater detail on Thursday. Oh, and here's definitely a reminder to join us Thursday if you'd like to know more about how you might pair those programs. Now, a couple of things I wanted people to think about real quick, was that if you walk into a lender that's reputable to you, that perhaps your friends or family have gone to a lender recently and they say, hey, this person's really great, go see them. For whatever reason, if they're not willing to help you with down payment assistance in conjunction with a good first-time home buyer loan, that's probably not the right lender to go to. It is a challenge to work on those types of loans. So you want someone who's ready to roll up their sleeves and help you as best as possible. Very much you can use multiple options to close a loan. Recently helped 5 people use down payment assistance, a second down payment assistance program, and close on a land trust. So, come Thursday and you'll hear some more about that. Creative down payments, I want you to think about some things that you might have not considered. The prices in Colorado are so high that sometimes to come up even with a 3%, it's really, really difficult. So you can accept gifts from family members. You just have to document it. So that's, let's just say, grandpa wants to give you part of your inheritance early. He's got $12,000. He'd like to help you become a homeowner. Well, grandpa has to show that he has the $12,000 to give you. So, that might be the hard part. He's got to part with a bank statement or wherever he's got this $12,000 housed to show you he has the money to give. A copy of his check that he writes you for that $12,000. You have to show that you've deposited the $12,000, and he has to fill out what's called a documented gift letter. And it just basically says, his name, your name, the date he's giving it to you, and that it's for home ownership. And that has to be a family member. But if you look on the conventional websites, you can see that family members is a huge variety, because we all have such sort of yours, mine, ours, theirs, just many stepchildren, in-laws, you name it. There are many acceptable forms of family these days. So please check that out. The 401k or the 403b loan against a retirement account, That's how I bought my first house. I was about $1,800 short of having enough with 3% down, and my closing costs with down payment assistance, I was still short. So I took a small loan against my 401k. I paid myself back with interest, which was great. Did not get any tax repercussions because I took a loan. I did not take a withdrawal, and I was able to go ahead and become a homeowner and have my 401k intact. And it was a win-win, believe me. Um, Now, the last one there, the sale of a documented asset, that's a little more difficult, and you just want to be very careful not to sell the asset without documenting it. So if, for instance, you own a 1971 Volkswagen van that's worth $8,000, um, and you're ready to part with that to purchase a home, then you want to make sure and take a very clear picture of that title, proving that you own the car. The title would show there's no lien holders against the car. Then you're going to take the cashier's check from the person buying the car, picture of that, and then you're also going to have to prove that you put it in the bank account. So then you're going to prove that you've put it in, deposited it, and then the funds. So, it's going to be a lot more difficult, but can be done. And I've had people sell everything from antique wedding dresses to jewelry, and even ranchers selling. They've had 4 horses and only needed 3. So they've sold one, for X amount of dollars. That gets a little trickier, and you certainly want to get really good advice on that, but it's very much acceptable to sell an asset. Talk to your originator if that's what you intend to do, to fully document that. Um, the way to think about things is seller paid items. Um, right when the interest rates started to climb, sellers were offering either to raise the price of the house, to give you money to buy down the interest rate. I don't know, kind of throw up your hands, decide whether that's an economically good decision or to use it to bring the loan amount down so your mortgage insurance is cheaper. Um, if you have a conventional loan, it's probably a good idea to think about which way makes more sense to you. Sellers also can pay on a 97% conventional loan up to 3% of your closing costs. Always a good thing too, if you've saved your 3% and you're going a little bit skinny on closing costs, to consider asking the seller to pay a portion of your closing costs. And just this little quote here from Walt Disney: "The way to get started is to quit talking and begin doing." I think it's so true of home ownership. It's a fantastic chance and ability to gain gain wealth, or have an asset that begins to it does 2 things. First, it becomes a wealth building asset the day you close. As you make payments, you're paying down your loan amount. You pay down that loan amount, pay down that loan amount very slowly on a 30-year. But about 8-10 years into that loan, you start to chunk down that principal balance, and that's coming down. And then in Colorado, we experience this thing called appreciation quite heavily. That's not going to happen in every state you live in, but in Colorado, you really start to do this because you're getting that appreciating value going up, and you're paying down that loan amount, then this space gets wider. So your asset, what they call the liquid asset, the amount that you owe versus the amount of the worth, grows and grows. And so in Colorado, you have the opportunity to really build wealth by becoming a homeowner. Now, yes, we're also faced with very, very expensive homes to buy. We'll talk about that more on Thursday, some opportunities through land trusts and some other avenues to bring down that cost. But if you start to plan, even if it takes, a year, 18 months, 2 years to buy, um, the really good spot to start in is that awful B word, budget. And nobody likes to budget, but man, you can look at your own budget and pick ways to save. So I encourage everybody to think about, you know, chop off $25-$30 a week on what, maybe you go get, uh, well, I shouldn't name names, but junk foods, 3 days a week. And these days it's $30 later. If you just get Chick-fil-A once, it's for two people, it can be, 22, $24 a pop if you get it each time. So, everybody should just look and see how they could save. And if you start saving and start saving, pretty soon that money starts amounting. And then think about that if there's a possibility of using a 401k or a 403b and taking a loan to purchase a house. Even if you don't do it right now, but just investigate, is that an opportunity? If so, what does that look like? But I really encourage everybody that's going to hang around in Colorado very long to fire their landlords over time and look and see, a little bit harder how to get into home ownership. Thanks, everybody.
Amy, we do have a couple of questions.
Okay.
One of them is when you're talking about down payment assistance programs, is that a grant or a smaller loan, or how does that process work?
It's going to depend on the individual program. Many of them are gifts. So they will ask you if you live in the property, say, for instance, the First Bank. Their program is if you live in the home for 3 years, they forgive it. Some of the others become what they call soft seconds. So they're going to sit out there until you refinance or sell. If you never refinance, let's say, for instance, the Chaffa, that one, you would pay it off when you sell the loan. If you pay off your 30-year loan, then you'd have to work on paying off what they call the silent second at Chaffa. If it's the down payment assistance, that one's forgiven. And forgiven means that you just have to stay being that's your primary residence for a certain number of years. We will go through that quite heavily on Thursday. And, we showed you 4 here on Thursday. We'll show you probably, oh goodness, I think it's 6 or 8 of them that are out there just to make things more confusing, but also open up those opportunities. And then if you need any help with that, you can reach out to my email or to Audra, and she can help you get to me. And I'd love to spend some one-on-one, even if it's on Teams, on Zoom, just to give you some one-on-one options for some of those tough questions. Okay.
I did put Amy's contact information in the chat so that everybody has it. Another question that came through is with the kind of the creative down payment process, why can items not be sold and then proof of the money in the account is proven after the fact? Why is extra documentation needed?
Well, it's going to sound funny, but it goes back to the money laundering laws. When you involve a conventional loan or a governmental loan, they want to know the source of all the down payment that's been used to purchase that home. They're looking for illegal money laundering. Not that someone's going to go out and sell drugs to buy a house, but they are going to make sure that that money has come from reputable sources, documented assets. So by taking, picture of that title that proves you actually own that car to sell, that that's going to be the first document. The second document's going to be the cashier's check that that person gives you, because they know that the cashier's check didn't come from the air. It came from a reputable uh, banking institution or credit union institution to generate a cashier's check. They can't. They would have had to prove that the person had those funds. So it's checks and balances in the money realm. And if you haven't worked for a bank or haven't really dealt in bigger amounts, anything over $3,000 is really looked at heavily and hard. And each lending institution or credit union bank has to account for the source of the monies that are of 3,000 or higher. I hope that answered it.
Looks like it. And we've got a couple more questions in here. One of them is, if you have 20%, you cannot use the down payment assistance. Is that correct?
Not necessarily. So if you would probably still have to support need a small amount, but some of our houses are so expensive that sometimes that 20% to bring it down, you would still have closing costs. So if if you've used all your money for your down payment and you still need help with the closing costs just to avoid that mortgage insurance, then that in itself would be need.
And then these two questions are kind of related, so I'll ask them together. Do builders mortgage companies have the ability to lower rates, and what is a buy down?
Okay, so do builders mortgage rates? Okay, I'm sorry.
So if with home builders, sometimes they advertise different
Oh,
rates, or they advertise different specials. Can they do, what was the question? Do they have the ability to lower rates? A builder's mortgage company?
not I mean, they have the ability to set a rate. They may have some kind of what I would call a teaser program. So I'd be really careful. Builders kind of got into a situation with the interest rates being so high that and those interest rates coming in high came in high quickly. So they may have been in the process of building, 5 to 8 homes that they anticipated selling to borrowers at, the old rates of 3 to 5%, and now they're looking at 7%. So they're trying to get those same homes bought. So they may have teaser rates where they would offer a lower rate for a duration, and then it's going to go back up. And that's sort of similar to what a buy down can be. You want to be really careful with buy downs, because buy downs can be as different as loan products. Now there used to be standard buy downs. It's going to sound funny, but my first house, I'm old enough, my first house was bought when Jimmy Carter was president, and my first rate was 14%. And I got a buy down from 14 to like 10. And it was a 4% difference, but it would come then back up to the 14% in a certain number of years. So you want to be really careful with buy downs. You want to understand whether you're in a 2-1 buy down, 3-1 buy down. And here lately, with the buy down being such a hit situation, people have been inventing their own buy downs. So you really need to pay attention if you're talking about a buy down. But a buy down, usually a traditional buy down would cost you 2 points. So that's 2% of the loan to buy down the rate. And that's why if the seller will give you 3%, you might be able to permanently buy down the rate by 2%. Now, a permanent buy down can actually make something a lot more affordable. But as far as buy down goes, you want to really be careful. And most construction lenders even though they're offering their own kind of loan, you might want to go to a lender and say, I want to buy this new construction home over here, and I want to see if I can qualify. Well, let's say, for instance, is First Bank, okay, just as an example. You go to First Bank and they say, yeah, of course, brand new home, down payment assistance is available for that as well. 30-year fixed, and I can give you blah, blah rate. Then at least you have something to compare it to when you go to talk to the builder, because the builder may have that available as a marketing, how to market his new homes, and it might be a good product, but you should also check with another lender and just kind of compare. It's always great to have a comparison. And the builder, he won't be bummed out if you get your own loan somewhere else. Unless he happens to also own the mortgage company. But you want to be careful. It's called a non-arm's length transaction. You want to keep everybody sort of on an even kill. So it's always good to kind of shop around. And what's awesome is, like I said, if you need any honest lenders, I have to give you at least three, and I have three, and I would love to do so, is to find a lender that's willing to show you what is the approval of the home ready, because you're at 80% or less, or what about the standard 3% down, and then what about one that's 5% down with the seller paying 2%? Those kinds of things. You need somebody that's willing to kind of help you say, here's what the principal, interest, taxes, insurance, and mortgage insurance looks like for this loan. Here's what this looks like with a 2-1 buy down, and that kind of thing, to sort of help you understand what options are available so that you can look at it and see which is best for your family.
Looks like that was our last question, Amy. So
Oh, great.
thank you very much for Amy for being here, and to everyone who took some time out of their day.
Yeah.
If you only caught part of this, or if you have coworkers who are like, oh, I forgot about it, or I wasn't able to attend, it is being recorded, so it'll be posted on the Employee Housing webpage probably sometime next week. And then, Amy, did you have any final thoughts you wanted to share with us?
No, if you want some more information on that, down payment assistance and programs where you can kind of mix and match the good loans with, be sure and feel free to register for Thursdays. And we of course are offering these same programs in Spanish in case any of your co-workers might enjoy watching in the Spanish language as well.
Thanks, everyone.
Bye.